Hello friends, welcome to the next video of Applied Finance Simplified. I am Ruzbeh Bodhanwala, and today, using a very simple concept popularized by Warren Buffett, we will try and prove how index investing is useful for retail investors. Our study suggests that if equity investors remain invested for a long period of time in equity markets, they can generate a wealth in excess of 13.2%. We will also learn how to use XIRR to calculate the returns by SIP investors. If all this interests you, please continue watching. In one of our previous videos, we discussed how expense ratio can make a meaningful difference to our wealth and what all we should keep in mind before investing in mutual funds. Today we will learn about index investing and how can we use this powerful style to maximize our return. Warren Buffett needs no introduction. However, Warren Buffett is an American investor, a business tycoon, a philanthropist, and the chairman and the CEO of Berkshire Hathaway. He is considered one of the most successful investors in the world and has a net worth of over $100 billion as on 11th March 2021. As on the date of this study, one share of Berkshire Hathaway is priced close to 398840. If I translate this number into Rupee and use a conversion factor of 74, then you will be surprised to know the value of one share of Berkshire Hathaway is close to 2.9 crore. Most of us will not even dream of investing and buying one stock at close to 3 crore. Letters of Warren Buffett have a lot of wisdom for investors, and at Flame University, these letters are taught as a part of the curriculum. Warren Buffett, in his letter to the shareholder in the year 2013, made a very interesting observation. And I quote, "My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost Standard & Poor's 500 index fund." Using this, we will try and backtest if an investor would have invested in Indian equity index fund in the year 1997 and continued to remain invested till 2021, what is the return that they would have generated? Before we move on to that, as you can see, we have downloaded price of Berkshire Hathaway A stock and Standard & Poor's Composite Price Index. If you see, the CAGR for Berkshire Hathaway stock is close to 10% between the year 1996 and 2021, and for Standard & Poor's it is close to 8%. If we move a little back and we check what is the CAGR from 1977 to 2021, it is a mind-boggling number, close to 21%. And this 25% return, that too in a US market, justifies the price of one stock, which is the costliest in the world, close to 3 crore INR. So now let's understand how index investing is beneficial to the shareholder. Let's assume that an individual invests in Nifty 50 in the year 1997, 10th of March 1997, where the index value was close to 1079. If this person remains invested till 2021, where the index value is 15175, we would calculate the CAGR and it will work to close to 11.65%. Please remember, we are assuming that the person invested in 1997 and he remains invested. Now let's see what is the risk of investing in equity. So for Nifty 50, we have obtained the index values which are in column L. When you see 1, it is nothing but the return of 1 year, the rolling return of 1 year. So the 1% is a return if you hold from 97 to 98. 1% minus 1% is a return if you hold from 98 to 99. 49% is a return if you hold from 99 to 2000. The second column that you see is a 2-year rolling period. So if you see 21% here, this is nothing but a return if you invest in 1998 and hold on to 2000. So it is approximately giving you 21% return for a holding period of 2 years. Similarly, you can see that we have calculated the holding period from 1 year to 15 years. So if I click on this value, you would see that if a person invests in 1997 and holds on till 2012, his return would be close to 11%. Now let's analyze the table. Observe the values here. The minimum return that an investor will get if he remains invested for a 1 year horizon can be as low as minus 46%. If the person is lucky, he remains invested only for 1 year, his return can be as high as 98%. So if you observe in this column M on my Excel spreadsheet, the minimum and the maximum values you will be able to figure out. Now let's see the most interesting part, which is the standard deviation. Standard deviation is the deviation from the mean. So standard deviation for the 1 year holding period is as high as 31% or typically 0.316. Now the interesting part is, as your holding period increases, the standard deviation continuously goes down. So observe the data in this row, which is continuously going down. So with a holding period of 15 years, the standard deviation goes low to as low as 1.7%, which is nothing but 0.017. Now observe how the minimum and maximum return behaves. As your holding period increases, the minimum return that a person would have got is 11%, and the maximum return that the person would have got is close to 16.7%. Isn't that very interesting? So friends, this is what it is. When you invest in index and hold it for a long period of time, the standard deviation reduces and the range of minimum and the maximum returns also narrows down. Now let's see, if instead of investing at one point of time, if you would have done a SIP of 10,000 every year, how would your returns be? So in this column, we have assumed that a person invests 10,000. In the next year, that 10,000 grows by the rate of return, the index grows, and 10,000 again is added to the corpus. So in this manner, at the end of 2021, the return would be close to 160399. If we calculate the CAGR, it works out to as high as 13.2%. Please remember, SIP investing is a much safer way because in that way you benefit from the averaging. So if you see, the CAGR of a person investing in 1997 up till 2021 is close to 11.65, whereas the return from SIP investing is much higher. Now let's move on to the last part, which is how to calculate the XIRR if you are a SIP investor. SIP investors typically face a problem. Sometimes they miss out, sometimes there is a lag, sometimes they are concerned, sometimes they withdraw money, sometimes they decide to invest more money. So XIRR is the only function in Excel which can help you precisely calculate the returns that you have generated over a period of time. Now XIRR is a very powerful function which captures the date and the values and gives you a rate of return. So please write down the dates on which you made the investments and the amount that you invested. The problem with this function can be if your date formats are incorrect. Now, if you are a SIP investor, it may have happened that over a period of time you have increased your investment. So if your investments are going up more than 10,000, you can write a greater number, and obviously your maturity value will also change. But XIRR is a function which will be able to handle all these problems, and you just have to apply the function XIRR, select the dates and select the values, and XIRR will tell you what is the rate of return on your investments. Guys, I hope you have liked this video. Please share and subscribe. Thank you for watching.